I'm Janelle Stolten-Holtmeyer, Associate Editor of Modern Distribution Management, and today I'm talking with Dan Mextroff, Chief Economist and Director for Economic Research for the Manufacturers Alliance MAPI. Hi Dan, how are you today?
I'm great, thank you.
So, a lot of the headlines right now are around the federal debt limit. Could you talk just a little bit about the practical implications of not raising the federal debt limit?
If the debt limit is not raised, it would be an unmitigated disaster. It really is taking an extremely high risk to create pressure in Congress to change the federal budget situation. The way it will affect business is, first of all, the federal deficit will be about $1.2 trillion. Just to put this in perspective, the U.S. economy's growth, in other words, the marginal growth, is only $54 billion a month. So the federal deficit almost is twice the growth rate of the general economy in terms of dollars. If there is a debt ceiling that's reached, the federal government will only be able to spend what it takes in receipts, which means it will be short over $100 billion a month. So I think we will go into a recession fairly quickly. It's to be determined how the government will prioritize payments, but almost surely they will stop paying federal contractors. It will renege on the full faith and credit of the United States, which will have long-lasting implications. The default, depending on whether they redeem treasuries or they suspend interest payments on the treasury debt, will cause difficulty in determining value of securities. Many firms use treasury securities as the safest asset available, and they use it in day-to-day transactions to control their short-term currency needs. And money market funds use short-term treasury securities to create liquidity so that they can redeem withdrawals. So if there's a default, firms will be unable to determine the value of a treasury security. It's not that they don't believe the treasury won't pay them eventually, but they wouldn't be able to determine the value of a short-term security because they wouldn't know when they would get their interest payment. It would create havoc in the financial community and could result in banks not being able to make loans because they couldn't be guaranteed of liquid positions. Another factor is that a third of all federal debt is held by foreigners. The largest holder of U.S. federal debt is China, and the second largest is Japan. China has already started to diversify out of dollars into other currencies. And to the extent that other countries do that, it will raise U.S. interest rates and make it more difficult to finance our debt in the future and at higher rates. And since the Treasury security is kind of the base, the risk-free rate, other interest rates will rise correspondingly. And then almost certainly we'd have a credit downgrade. We may even get a credit downgrade even if the debt ceiling is raised, because unless we show the rating agencies that we're serious about solving our long-term federal deficit problem, most likely they're going to downgrade U.S. debt. That will, again, almost certainly raise U.S. interest rates. And then finally, it may accelerate the change or the trend away from using U.S. dollars as the reserve currency or as the most widely used currency for transactions. U.S. businesses benefit by being able to buy commodities in U.S. dollars without having to convert to other currencies.
So, beyond the federal debt limit, it seems that uncertainty in general has returned to the U.S. economic picture. What's your take on the near-term outlook for the U.S. economy?
Well, the U.S. economy did slow in the first half of the year, but there are reasons why that occurred. One was abnormal weather conditions. We had severe winter storms that affected transportation. We had spring flooding, which shut down factories and businesses along the Mississippi Valley and other rivers in the Midwest. In addition, there was very high commodity prices, which reduced consumers' income after inflation, for example, gasoline prices in particular, but also food prices. And then the Japanese tsunami created severe supply chain disruptions in the transportation sector, particularly motor vehicles and parts. Also, a lot of semiconductors. Japan accounts for 20% of all semiconductor production and 40% of all flash memory production. Those prefects in Japan that were affected by the tsunami accounted for a disproportionate number of semiconductor and fab plants. So it had effect on the supply chain for high technology products. In addition, there was another decline in housing activity in the first half. We had the state and local governments accelerating cuts as the federal stimulus kind of wore out for state and local governments. So there was a slowdown. GDP, gross domestic product, increased less than 2% in the first half on a quarter-to-quarter basis. However, I think there's reasons to expect that many of those factors that slowed the economy in the first half are going to unwind, and we'll see faster growth in the second half of the year. We already know that there's large increases in motor vehicle production schedules in the second half. Their inventories were driven down when their production was limited, but yet sales continued to grow in the first half. Recent decline in food and gasoline prices give consumers more spendable income, so we should see a pickup in consumer spending, and particularly for motor vehicles, because right now the current level of motor vehicle sales is not enough to even keep the stock of motor vehicles growing. That is, the stock of motor vehicles is continuing to decline because we're below replacement rate. So there's got to be a tremendous amount of pent-up demand for motor vehicles. Repairing the old car eventually becomes uneconomical. And you can say that about many other things, like appliances and furniture. Many of the big-ticket items, there should be pent-up demand for consumer purchases. And then finally, as we get closer to the end of the year, there'll be more and more firms rushing to take advantage of the 100% depreciation or expensing for capital equipment purchases this year. And then in the ongoing strong growth in exports because of the current decline in the value of the dollar, making U.S. goods more competitive in the world markets. When you combine all those factors, I think we're looking for a faster growth rate in the second half, but still it will not be what you would consider strong. In the first half, we averaged a little less than 2%. In the second half, I think we'll average a little more than 3% growth. But for the year as a whole, it only works out to about 2.5% growth in the U.S. economy, which for this stage of the cycle, coming out of the Great Recession, the worst recession since the Depression, is really a slow recovery. There's no other way of putting it.
Is the outlook for manufacturing still strong, or is it moderating some as the rest of the economy remains cool?
Year over year, manufacturing production is faster than the general economy. Manufacturing production will grow about 5% this year. That's in physical volume. And the general economy will grow about 2.5%. So you could say manufacturing is growing twice as fast as the general economy. In terms of what we've seen recently, this quarter, there has been a pretty substantial slowdown in manufacturing. In the first quarter, manufacturing production grew at a 7% annual rate. In the second quarter, it grew at a 0% annual rate. Now, the reason for that was the reasons that I discussed before. That is, there was a decline in automobile production. There was a decline in, or a reduction in, the growth in high-tech industries. There was a disruption because of the winter weather, the floods, you name it. There's a lot of factors, one-off factors that affected manufacturing production in the second quarter, which we expect to unwind in the third and fourth quarter. So we expect a rebound in manufacturing production. For the year as a whole, it's growing faster than the general economy. Next year, we're looking at 4% growth in manufacturing production, which again will be faster than the general economy, which should grow maybe 2.7%.
What are some other areas other than manufacturing where we're starting to see some more of those signs of recovery?
In the general economy, we're past the recovery phase. We're in the expansion phase. Back in the fourth quarter of 2010, economic activity, U.S. GDP, exceeded the level of the fourth quarter of 2007, which was when the economy previously peaked. So we have fully recovered all that was lost in the recession, and starting in the first quarter of this year, we went into the expansion phase. We're actually growing. We're posting stronger, larger economic activity than occurred before the recession began. So most industries are in recovery. Many industries are in full expansion. The ones that are still declining are utilities, real estate, finance, insurance, the government sector, particularly state and local government, information sector, and construction sector. In manufacturing, to kind of put it into perspective, we're about halfway through the recovery. Manufacturing production fell 20% from peak to trough during the recession. It has rebounded about 12%, and so it's about 11% below its previous cyclical peaks. We're just a little bit more than half recovered.
On another note, capital investments have been dampened by the weak economy and the uncertainty. Can we expect to see activity in this area picking up?
I have to disagree with you. There's two pieces to capital investment. There's equipment and software, and then there's structures. It is true that structures have continued to decline and are in recession. That's why I talk about construction is still in recession. But equipment and software spending is almost 3 times as large as structures or non-residential construction. And equipment and software spending has been strong. In fact, equipment and software spending started to grow in the second quarter of 2009 before the recovery even began for the general economy. And it has been growing strong enough that it's offset the decline in structures or non-residential construction. So in general, non-residential investment in total has been growing at a fairly strong rate. So for example, this year, and this is inflation-adjusted dollars for physical volume, non-residential investment will be up 8%. Remember, the general economy is only going to grow 2.5%. And we're looking for 8% growth next year in 2012 when the economy only grows 2.7%. The equipment software investments up 11% this year and 12% next year, while structures or non-residential construction is down 1% this year and down 3% next year. It's been driven by several factors. One is the big increase in profitability of corporations. Another reason is the fact that so much capacity was taken out during the recession that when you even had a modest recovery, it was enough to cause utilization rates to rise. It highlighted the bottlenecks in the production processes and also encouraged firms to invest in equipment to repair, replace, upgrade, and make productivity-enhancing investments.
Unemployment has definitely been remaining stubbornly high, and job creation appears to be more sluggish than expected. What's behind this challenge?
Well, the fact that we've had a sluggish recovery. What we have right now is a situation where we have relatively high productivity growth. So firms can produce 2.5% growth in output without adding very many workers. We need 1% increase in employment each year just to absorb the new entrants to the labor force. What you really need is 2% growth in employment to absorb the new entrants plus work down the unemployment rate. So in other words, to go from 10% to 9%, you need 2% increase in employment. We're just not seeing that. The good news is there's some growth, but the bad news is it's just not enough to dramatically reduce the unemployment rate. The reasons for this is, I think, business uncertainty. They spent 2 years reducing employment, and so they really are not convinced that we're in a sustained recovery. Another major factor is that we're seeing massive structural change in the economy. We're seeing major declines in residential construction and non-residential construction. Where do those construction workers go? There's no jobs in construction. They have to go to some other industry. And we're just not seeing other industries growing that rapidly to absorb them. And then we have problems geographically, where major declines in some of these overbuilt housing markets like Florida, Arizona, California. In California, they have 12% unemployment. Here in Virginia, we have about 6% unemployment. But how you get California workers to Virginia, where their jobs are? They may not be willing to move. They may not be able to sell their house. Their spouse may not want to quit their job. I mean, there's all these problems, these structural problems. So as a result, we end up with higher unemployment, and a very high proportion of those unemployed for a long period of time, over 6 months.
So what needs to change the trend?
Unfortunately, it's going to just take time. There's no magic button you can push. There's no quick fix. It's structural change. It has to occur. We need first to settle our long-term federal budget deficit problem. We need to reduce regulatory uncertainty that is causing businesses not to make investments that they should. We need to reduce the corporate tax rate below average. Right now, I think Japan is the only major developed country that has higher corporate tax rates than the United States, which discourages investment. And we need to improve K-12 education and provide vocational education avenues for students who do not want to go to college. Right now, we look down on vocational education. And we just have to realize there are people who don't want to go to college, and they should have viable options. Those are just a few things. But again, these are structural problems that have to be addressed, and just going to take time.
So we covered a lot of topics here, but is there anything else that you'd like to add?
I think you have to realize that the growth model that we used in the past won't work in the future. We have no other option. We built an economy in the past based upon debt. That is, the least creditworthy people getting more and more credit using their house as collateral. So we were spending more than we were earning, and we just can't do that. It's impossible to do that going forward. All the growth is going to be based upon employment growth and wage growth. It's the old-fashioned way of earning it, and we can't rely on debt to accelerate the growth rate of the general economy. So I guess we're going to have to solve our problems. We can't postpone them anymore. Unfortunately, that means a relatively slow expansion over the next several years.
Thank you very much, Dan, for your time today.